You're listening to the Commit to Wealth podcast, episode 16.
Welcome to the Commit to Wealth podcast, providing you with the expertise and proven strategies to scale your real estate business. Learn from today's top real estate entrepreneurs and build your own wealth. Your legacy and commitment to wealth starts now with your host, Juan Vargas.
Hey there, CTW Nation. I hope you guys are doing fantastic today. Usually on the show, we talk about multifamily investing, but today we're going to do it a little bit differently. Our guest today is Andrew Lanoie. Before starting in real estate, Andrew was a talent agent at William Morris for 16 years. There, he represented some of the world's biggest celebrities, including Tim Allen, Sheryl Crow, Barry Manilow, and Peter Frampton, just to name a few. In 2009, during the recession, he began investing in single-family homes and had acquired over 100 properties in less than 4 years. But it was also during this time that he noticed there was a huge demand for affordable housing. So he decided to leave the agency and focus full-time on providing affordable housing, specifically in the mobile home park space. And in less than 5 years, Andrew and his team have been able to close on over 1,600 mobile home park lots and counting. So let's get right into the story, guys, and find out why mobile home park investing is a good way to create good cash flow and build wealth.
And now, welcome this week's entrepreneur.
Andrew Lanoie, I hope you are doing awesome today. Thank you so much for joining us.
Hey, I'm doing great, Juan. How are you?
I am doing awesome as well. Thank you.
Yeah, I appreciate you having me on, and awesome job on the podcast. And you've had some pretty great guests. So great job just kind of giving back, because education is just so important in the real estate world.
Yes, it is. It's very important. Keep learning it and get all the new info because it's always changing, right?
Absolutely. Yep.
Okay. Well, Andrew, let's start off by telling my listeners where you're calling us from and kind of dig into your background a little bit.
Yeah, sure. So I'm calling you from Phoenix, Arizona, where I'm based currently. I moved here last year, and I've got a partner. My partner, Mike Ayala, is here, and we've got an office that we've opened, and basically using Phoenix as our headquarters. But I was living in Los Angeles for about 20 years. And the short story is I worked in the entertainment business for about almost 20 years. I worked for a company called William Morris, which is a big talent agency. If anyone's ever seen the show Entourage, that was our company. We actually created and packaged that show. So I worked there for about 16 years and represented comedians and different bands. So everyone from Tim Allen to Peter Frampton to Taylor Swift to all kinds of folks. And basically what happened is when the market crashed and the subprime crash happened, and I, along with a lot of people, had most of my money tied up in the stock market and lost a bunch of money in the market. And my parents lost a bunch of money along with a lot of other folks. And so that was kind of my big eye-opening what the heck happened, and started me on my real estate path and my investing path, and just started to read a million books, and that kind of kicked everything off.
Yeah, and it seems like it's something that's always happening, that it kind of changes your trajectory of your path, right? And so that kind of happened to you as well.
Yeah, it's exactly right. And, I was working at probably what most people would consider a dream job. You're making a lot of money, or, you're working with celebrities, you're working in Beverly Hills, you're driving a nice car. I mean, all the stuff, right? But it's still corporate America, and it's still a lot of BS and a lot of politics you're dealing with. But sometimes you just don't, it's easy to go and get a W-2 job. And sometimes you don't really know that there's more out there until something kind of shakes rattles your cage a little bit.
Yeah. So now that we're talking about that, why didn't you just proceed with finding just another job, or finding something like that where it was a little bit easier to transition into?
Yeah, I think it was pretty simple. I mean, once I started, and that's why I appreciate what you're doing with the podcast. I mean, the education part of it's so important. I started going to real estate groups in Los Angeles. I found a few mentors, And once I really got my head wrapped around real estate, I started buying single family houses in 2009, and actually Dallas, Texas, which, hindsight being 2020, that was a phenomenal time to get into single families. And so I was still working at the agency, buying single family houses. And I think once you kind of understand, buy and hold real estate, and you're buying for cash flow, and you're not trying to time markets and things like that. Once you get into it, a lot of us really are deal junkies, right? We're deal guys. So once you start getting in and buying deals and get your head wrapped around it, I found that was really my passion. I didn't want to work in corporate America forever.
Got it. No, I like that because you have to find out what the reason you're getting yourself into a certain space. And for you, you started off with the single family spaces. You started in Dallas, which is a great market back then, and even it still is now. But the timing that you got into the market was even better, right? But then from there, you were able to think about what it is that was most important, which is cash flow. And so, is that how you kind of transitioned into a mobile home park investing, or how was that?
Yeah, I stuck to single family from about 2009 to 2013 when I felt, at least for what I was looking for, deals were penciling out and I was still finding good returns. In 2013, I just stopped finding good deals, or at least for me, they weren't really penciling out. And I started looking around. I left the agency at that point. I started looking around at multifamily. I felt like multifamily was getting overpriced at that point. We looked at commercial, a lot of different asset classes. And then I had a friend who had purchased some mobile home parks in the Midwest, and then really took a good look at that asset class along with the others, and realized there was a huge opportunity there.
So how did you actually get into mobile home parks? I mean, was it somebody that you partnered with, or what was your big jump there? What was your big takeoff there?
Yeah, so I think it's like anything else. When you're looking at a new model, you've kind of you got to dive in. You got to talk to people who are in the space. You got to understand the numbers. You have to really analyze the whole profile of that, which I did. And then I had partnered up with someone, and we started buying communities back in early 2015. So we just jumped in and started buying deals.
Okay, so what did you find that was an advantage over other asset classes in the mobile home park space?
Well, it's definitely a niche. So a couple things, and to this day, we're still buying communities that are typically between 8 and 12 caps. So the return profile is strong. What's interesting is, our residents own their own homes in our model. So when we buy a community, we'll renovate homes, we'll sell those homes off to new residents, and then we'll bring in new homes to sell. So it's, unlike a multifamily where you're renting units, it's a totally different model. So you have to have that team built out. You have a marketing department. You're selling homes. So it's definitely a different barrier of entry to get started. There's a lot of moving pieces, and it's not it's just not like just going and buying a home and renovating it. You're buying a big community, renovating multiple homes within that community, and then selling those homes. So we saw that as an opportunity, because while people were chasing other things, we saw this opportunity to jump into this space, because it's just harder to execute on some of these.
And why do you say that is harder to execute? Is it because of the financing? Is it because you actually need a large team to be able to take one of these properties down? Or what do you think are some reasons on that?
Yeah, I think it's mostly just what you had said. The team is a big part of that. So we've got a property management company. We have, we're operating in 9 states now, and probably 13 or 14 markets. We're about to close on another 500 units in another four states. We've focused on the Midwest and the Southeast. So you have to have a team we have a property management company, we have a construction company, and then we have the private investment firm. So all of those require, employees and team members and partners and everything. So that's the biggest thing. It's, with at least the scale of what we're doing and what we're working on, it's definitely, you can't be a one-man band in this, with what we're doing.
Got it. Got it. You got to have a team to be able to advance in mobile home parks and usually in any other asset class as well. Is strength in numbers, correct? So you got to have a proper team. So let's dig a little deeper into the mobile home parks and give us some key advantages. Like I want to talk about like the taxes, the tax advantages. How different are those, say, compared to single family or multifamily?
Yeah. So on the tax side, when you're buying a community, obviously if you're buying a single family or multifamily, you've got a building that you're depreciating over a certain amount of time. Well, on the manufactured homes, I mean, these are chattel loans, and we don't own these typically. Our residents do, so we don't have the same depreciation on the home side or the structure side, but we do whenever we buy a community. We buy 10, 20, 30, 50 acres of land, and there's roads, there's infrastructure, there's common areas, there's lighting, there's a lot of things that you can depreciate over time. That's part of that overall land value. So we still get some pretty great depreciation and returns for our investors as well.
So yeah, like you mentioned, for other asset classes such as single family or multifamily, you get to depreciate the building. But in this case, the buildings or mobile homes are owned by the tenants themselves, so you can't depreciate that. But there are other things that you can do as far as like objects that are on the land. And so,
yep, exactly right.
Okay, so let's talk about what the tenant is responsible for, as far as what they pay and what the landlord/owner is responsible for.
Sure. So let's say you're buying a community and everything's direct billed to the city, just as an example. So you're out of the loop on most of the utilities. So the one easy way to describe it is anything above the ground is the resident's responsibility. So that could be that their stove isn't working, that their cabinet door fell off, anything that's really part of their home is their responsibility. And because of that, the expense ratios are less than, let's say, multifamily, where everything as part of an apartment is the owner's responsibility. So anything really above ground is the resident's responsibility. Anything below ground, sewer, water, things like that, it's typically the owner's responsibility, or the whoever owns that community, as well as keeping the roads maintained, tree trimming. There could be acres and acres of grass to mow, and all of those things that kind of fall under the general maintenance and maybe capex of a property.
Got it. So what happens if you have a mobile home park that is like outside of the city limits and it's like out there in the country somewhere? How does that work? I mean, you're going to have a water well and things like that, but so that's going to be your responsibility as an owner, or how does that work?
Yeah, I mean, it's case by case. You've got some that have water systems or lagoons and things like that. We generally try to stay away from those and have as much direct build as possible. Sometimes you've got utilities that are sub-metered, so it's case by case. There's not not just one profile of a mobile home community. There's there can be a bunch of them. So it's really it probably just really goes back to what your buying parameters are, right? And if you're looking for certain parameters, then when you're looking at communities that have things that fall outside that, you just simply may not buy those.
Got it. So let's get a better understanding of the income and expenses, like a P&L. Can you quickly go through a P&L, like down the list and of items that would be classified as income and items classified as expenses?
Sure. I mean, on the simple side of things, so if you've got income, just like multifamily, you've got lot rent, right? That's really your main core income is.
What do you typically charge for these lot rents as well?
Yeah, so it depends. For our communities, it's as low as a couple $100, and probably $200 to $300 and change, something like that. And again, we're buying kind of in the Midwest and Southeast, so that's just lot rent. So someone's going to pay that as long as they're living there, and that's kind of their core rent. And then you've got, let's say, a resident owns their home and they've been there for 20 years and they own their home outright. They're only paying lot rent. They're not paying anyone a note payment or anything on the home. Or if we have a new resident that's coming in, and let's say they buy a brand new home, and we work with Clayton manufacturer who's the biggest manufacturer in the United States that's owned by Warren Buffett, and then 21st Mortgage finances those homes. So let's say someone comes in and they buy a brand new home that costs $50,000. They're going to put down 5% on that home. They're going to pay 7 to 9% interest rate and maybe a 20-year AM. So for about the same cost as lot rent, let's just say around $300, they're going to own a brand new home that they're making payments on for 20 years or something like that. So you've got lot rent, you've got a payment for a home, which could be a renovated home or a new home. And just on a P&L side, other income, you could have a utility recapture. You could have, unfortunately in affordable housing, late fees are an actual real income stream. If anyone, is in affordable housing, they know that. So those are the big income, really the big income streams in our asset class.
Great info. So what does your typical deal look like? How long do you plan on being in the deal? And like, what is your business strategy for whenever you go and finding these different opportunities?
Yeah, so a lot of them, some of it's been dependent on who our investors are and what they're looking for. We have some deals that we're going to hold on for probably more than 10 years. We've got some that we have very specific 5-year exits where it's either a cash out refinance that they're going to get out with, their capital back and then stay in the deal, or it's simply a sale by the end of 5 years. So on the fund model that we've done, it's typically a very specific exit because that's really what our investors are really looking for. So we've had some people that have come in on direct investments where they've just been one partner and they want to hold these for a long period of time. And so that, it depends on how you structure them and how many investors you have in the deal. But our basic rule of thumb is, the more investors that you have in one particular deal, it needs to be a very specific exit. But we're not buying and flipping these, or, they're longer term holds.
Got it. So it's kind of like a on the multifamily side of things, where you have to have a business plan going in. Usually it'll be anywhere from 3 to 5, or sometimes it can be longer. But you are correct on that you got to make sure that you find out what the investors' plans are and what their goals are, and kind of a plan around that, right?
Yeah, and and more specifically on the fund that we have, it's a 5-year exit. So irregardless, within 5 years, the investor's going to get their money back. So, if you've got 50 people in a $10 million deal, you're never going to get everyone to agree to one exit. So you just simply have to set that, knowing what your investors' expectations are.
Got it. So I want to talk about the financing on one of these mobile home parks. So let's get into that. Talk about how difficult is it to qualify, and what kind of financing is available even for these, and what do the terms look like?
Yeah, so some of it's similar to multifamily and some of the commercial side. So some of it depends on location, what the occupancy is, and a big part of it's also how many park-owned homes that are part of the deal. So you could buy a 100-space park, and there could be 80 park-owned homes, and the park-owned home is simply what's referred to as, it's a home that's either being rented potentially that the park owns, or it's a home that's vacant that needs to either be renovated or just torn down, depending on the condition. So a lot of banks are not going to finance communities with a large amount of park-owned homes. So then, your options are all cash. We've had really good luck with seller financing. There's certainly, hard money and bridge and floater loans out there. So part of it's just dependent on the lender. You've got some lenders who don't want to lend on anything less than $2 or $3 million, and they want certain occupancy and certain number of park-owned homes. So a lot of it is dependent on the lender, just as much as the asset and the borrower.
Got it. So do you have any Fannie Mae, Freddie Mac type of loans in these? Do they typically try to stay away from mobile home parks, or how does that work?
Yeah, they're in the space. I don't know how prevalent they are, but they're definitely in the space, and I think they're on generally larger, more stabilized, and it may even be in larger metros. I mean, typically where we're finding good deals is in tertiary and secondary markets. So So we're not working with Fannie or Freddie in any of our communities.
Got it. Now that you're talking about the markets, I wanted to ask you on that. What markets are you looking at? Is it markets where the income is a little bit lower to be able to find these mobile home parks, or can you talk about what markets in general do you like to look at?
Yeah, I mean, basically, we're focused on the Midwest and into the Southeast. So the states could be Kansas, Kentucky, Tennessee, Alabama, Missouri. We're buying some parks in Indiana, Ohio. So we need to be in a market where it doesn't have to be a market like Dallas, Texas, where it's a big, big metro, but it can't be a one-horse town. And there can't be a meatpacking plant 20 miles down the street, and that's the only job driver. I mean, there has to be some, I mean, the whole retail industry. I'm sure you're tracking with us. I mean, Toys R Us is filing for bankruptcy. I mean, Amazon's taking over the world, but there's still, so who knows what's going to happen in 50 years from now or 100 years from now, but we need to be in areas where there's at least the mid box and the big box and the Home Depots, et cetera, within driving distance.
Got it. And what is the average income in the area, in the demographics that you're looking at?
Well, the number is 50% of wage earners in the U.S. are making $30,000 or less. So that definitely fits our demographic. I mean, that's kind of the affordable housing range. So that definitely fits our demographic.
I want to talk about your investors that you have in your deals. Who is the typical investor that would be the best fit for your type of projects?
Yeah, most of our investors, most of the projects we work on are for affluent or accredited investors only. A lot of them are very busy with either building their own empires. They're, doing a lot of, they're really looking for passive investments, or they're looking to diversify if they're out, flipping houses or doing other things. But generally they're busy and they're looking for just stable passive income. That's basically what our investors are looking for.
So yeah, basically accredited investors that have some type of steady income already, and where they're not looking to actually do this full time. They want to just invest passively into your deals.
Yep. Yeah, they're really not looking for another job, right? They've got plenty of jobs. They're just looking for some diversification.
Diversification. Yep, that is key. Yep. Okay, so what makes Four Peaks Capital Partners different? What separates you guys from your competitors?
Well, I think the approach has been a little bit different. A lot of the big operators in the space with 20,000 plus units, they're generally looking at more stabilized assets and they're looking at larger assets. So there's a lot of people and a lot of money chasing that profile right now, and we found a pretty interesting niche of communities that are in the 50, 60, 70% range. But in order to buy those and execute on a business plan, it goes back to what we were talking about before. It goes back to the team. And you need, we've got a construction company with quite a few folks, and we've got a property management company. So we couldn't acquire those without that team. So I think it's probably easier to buy a larger building that's more stabilized. You're most likely not going to get the kind of cap rates that we're looking at for the value add. So that's the big opportunity that we see right now.
Yeah, so that's kind of where you're targeting is the value add properties. So let's touch on that a little bit. What do you mean by value add? What has to be done at the property to be able to be qualifying as a value add property?
Yeah, you can look at it a bunch of different ways. So very simply, it's what's the occupancy. So if you buy something at 65% occupancy, that's pretty simple to sell units and bring in new units and raise that over time. Or you've got this happens quite a few times too. I mean, if you've got a community that started at 95% occupancy and over 10 or 15 years, it's now at 50% occupancy. There's been a lot of things that's happened along the way. Morale's gone down. There's a lot of deferred maintenance, and probably rents are below market. So that's another way. I mean, we bought a few communities in outside of Knoxville at the end of last year. The rents were around $200, and they should have been closer to $300. So it's not something you can come in and just ratchet up the rents immediately. You have to do it conservatively and over time. But the under market rents are another big thing. Sub-metering and utilities are another utility recapture. That's another way. So it's probably a good half dozen ways to look at when you're looking at a community. But it's where the rents and what's the occupancy.
So what makes it attractive whenever you take over a property? What makes it attractive to a potential tenant to go into your property versus somebody else's property?
Well, a lot of the time there's just so much deferred maintenance and CapEx that, again, it's a morale thing. You've got people who have lived in that community for a long time. Generally, those folks aren't moving around as much because they own their home. So it's not like an apartment building where someone is moving every year, or they break a lease every whatever the time is. There's a lot of people that are in these communities for a long time. So just by going in and putting in a swing set, putting in a barbecue area, tree trimming, fixing the roads. I mean, they're not, the communities that we own, there's not pools, there's not, these elaborate common areas because we're in affordable housing. It just doesn't make sense for the assets that we're buying. But it's just to clean up the communities and just turn them back into a community.
And that's one thing that I like that you mentioned is in the mobile home space. These tenants are typically staying in their homes for over a year. I mean, typically it'll be 2, 5, or even more, right? But in a multifamily space or even in the single family space, you have tenants that'll be there, once a year, and so you have a lot of turnover, and so that adds to your expenses because every single time somebody turns over a unit, that's added costs, and that takes away from your bottom line. So that's one of the biggest benefits that is key to maintaining your tenants and not have to worry about that. That's one thing is very attractive.
Yep, absolutely agree.
Okay, well let's get into our nuggets of wealth. And these are just questions that I like to ask every guest every week that can potentially help our listeners. And so I want to ask you, what is one key tip that you would give others who are looking to get started or take their business to the next level?
Well, I think the easiest thing, it's how I started, and a lot of people I know. I mean, go read Rich Dad Poor Dad. Just there are so many great books out there. Ken McElroy's got a couple great books on ABCs of real estate. I mean, there's so many great books to read. And there's a million great podcasts like the Real Estate Guys, Jason Hartman, Kathy Fettke. Obviously what you're doing. There's a lot of free resources and a lot of very inexpensive resources. So that's, in my mind, if someone has $10,000 or $15,000 and they're trying to figure out how to get into real estate, I would put a quarter of that into education first thing. I would not even the seminars or any of that stuff. I mean, just on books, and start going out to some local either Phoebe groups or real estate meetups. I mean, there's a lot of things you can do that don't cost very much money.
You're right, and there's a lot of guys that want to get into something like this, and they don't want to put in the time or the effort, or it doesn't cost that much to get out there. It doesn't cost that much to network it, in buying a couple books here and there. It doesn't cost that much, but people don't want to put in the effort. And I think if you want something, you have to actually work for it and do those kind of things. Read those books. And listen to these podcasts. There's so much information that you can learn. Andrew's providing so much information here for you guys that want to look into mobile home park investing and possibly invest passively into one of his deals as well. So definitely check it out. What is one key tool, source, or platform that you use frequently that can also help others?
Well, we use a lot of software. I mean, we use Podio, which is it's an open source CRM. We use Active Campaign. But I guess just personally, it kind of goes back to the education part, but Audible is amazing, right? So, I mean, that's where I really listen to most of my books is through Audible. So on that side, I try to keep it pretty simple.
Yeah. I want to ask you, at the end of your life, how do you want to be remembered?
Boy, that's a good question. I guess that a lot of us we're looking to leave some sort of a legacy. And Zig Ziglar's got a great quote, which I try to live by, which basically just says, if you help enough other people get what they want, you'll never have to ask for help. So I think that you've got to help the new people that are getting involved. You got to find ways to give back. I mean, through the companies that we have. I mean, we're creating affordable housing. We're creating jobs. There's a lot of good things that come from it, as well as just delivering good returns to our investors. But there's a bigger picture there. So, but I think the bottom line is you really gotta find ways to give back. And if you are an expert in something, or more than someone else on something, like, help them out. Become a mentor to someone.
Love that. That's a great answer. I love that. Where can Commit to Wealth Nation go to contact you and find out more about you and Four Peaks Capital Partners?
Sure. So the website's fourpeakspartners.com. It's spelled out FOUR. And we've also put together a report with more information on mobile home communities. And you can get that at reservedinvestments.com. Just like it sounds, reservedinvestments.com.
Got it. Great. So you guys definitely check that out. You have a mailing list as well, you said?
Yep. And there's a sign up on the on fourpeakspartners.com as well.
Got it. So guys, definitely check it out. If you guys are interested in mobile home parks, there's so much to gain from this. And so please, if you have to listen to the podcast, listen to it again, check out his website, reach out to him. Andrew, I appreciate your time. I appreciate, all the knowledge that you shared with us, and hopefully, there's some investors that can take action on this and take it from there.
Awesome. Thanks for having me on, Juan, and appreciate what you're doing out there too.
No, thank you very much. Guys, that was Andrew Lanoie with Four Peaks Capital Partners. You can check them out at fourpeakspartners.com. And also, you can download a free guide to private investments at reservedinvestments.com. So guys, that is it for today. I will catch you on the next one.
Thank you for listening to today's show. Head over to committowealth.com now and access the wealth of information Juan and his team make available exclusively to you, the podcast listener. That's committowealth.com, where wealth begins by giving and is created by having a defined purpose.